Let's talk markets with Mr. Kevin O'Leary, joining us, the chairman of O-Shares ETFs, and of course, one of the sharks on NBC's Shark Tank. Kevin, good to have you back on the show. What do you make of this big rotation talk that has captured the market the last couple of weeks, Kevin? Are we really going to see a turn into the companies focused on this economy getting back on its feet?
You know, I think one thing that people don't take into account regarding this recovery is normal recessions, the ones that we traditionally go into, or depressions, if you want to go that far, are a general grind down over 6 quarters, where you lose economic activity quarter by quarter for about a year and a half, and then you're in the depression. A recession takes 2 years to come out. Not what happened here. Basically, 48 hours shut down the entire economy. And the reason I bring this up is the pent-up demand at the consumer level, pretty well across every sector, is still there. We have the highest cash balances in people's accounts. You heard that out of Bank of America yesterday. And because it was such a short duration, 90 days, 100 days, that we've been out of the mix, this is not a normal recession. And so the markets are reflecting that. There's a lot of optimism. And I'm writing off earnings for the S&P this year. I don't care if they're 40, 50, 60, 70 cents, doesn't matter to me. I'm trying to gauge how long till we get back to, let's call it, 80% normal. Because I know there'll be sectors like real estate that are going to suffer, sports arenas, all that stuff, restaurants, I get it. But the core of the economy is intact. Policy probably remains the same after November elections. And I think that's a good outcome for investors, which is why you're seeing such resilience. I know there's some volatility, but these are extraordinary markets right now, given how many people have shorted them. They're getting their heads handed to them now.
Kevin, how did things in your mind get so lopsided in March to where this narrative about depression managed to catch on when it was pretty clear that the government help and stimulus was just going to come in full force? I mean, I think this morning explains a lot. You've got analysts and economists who are looking for 5% decline in personal income, and we actually hit up 10% because some people are getting paid even more.
Yeah, no, you're right. It's caught a lot of people by surprise. I would gauge a couple of things to think about as investors. I mean, let me give you some anecdotal data which I find fascinating. I do some work these days with sovereign funds in Riyadh and the United Arab Emirates, etc., because the World Summit is starting there and the G20 is going to happen in November. So I've been spending a fair amount of time in dialogue with some of those sovereign funds. Their bogey for this year in returns to be distributed is 6%. I will also note that the CEO of CalPERS last week said that her bogey this year was 7% return, 7% next year to be distributed. Now, the reason I bring that up is traditionally these funds would have had a typical 50-50 balance between fixed income assets and equities. That's not happening. They can't get even near their 6-7% bogey with fixed income. The government bond, even the 30-year now, even is huge duration risk with fractional returns well below 6%. And so what's happened is, in addition to the Fed's helicopter money, you've got billions coming into equities in search of a 6% return. So if you tiptoe through the tulips in the S&P 500, you can find a 3% dividend return, plus hope for 3% appreciation, and bingo, you got your bogey. So now you're seeing these firms go to 70% equities, maybe 30% fixed income. You can't underestimate the power of just those sovereigns and pensions, and then throw $2 trillion of free helicopter money on the economy from the Fed, and maybe an extra trillion, which to me is an overshot. But that's what's holding up this market and confounding the shorts in a brutal fashion.
How long can that continue if the main force behind this big run off the lows has been positioning, kind of one way to describe this, that then got burned from the shorts, which then kind of forced this Tina trade, there is no alternative, back into equities, the kind of chase, basically positioning at its core that was wrong. Then the next phase is what, Kevin? Do we have to see real growth? Do we need to see the data start to get better here? Or else then we're looking at a market with no earnings on the horizon? I mean, what's the next thing that needs to happen to keep this going?
I think the market's going to give you a good 12 to 18 months to settle out this whole idea of what the new normal is. But I would add a few things. You know, I was on the phone this morning with a hedge fund that is just short the straight index, the SPY, and begging me to stop this. I mean, it was just, you know, it's funny when somebody gets so offside that they don't know what to do except beg for a different outcome. There's a lot of that going on. But here's what you got to think about. if the Fed continues with this program and they have signaled to everybody that the checkbook is unlimited and they overcompensate by $1 trillion, which is what I think they're going to do as an insurance policy, where does that free cash manifest itself? It's going to expand PE multiples much sooner than we thought. So you could end up in Q4 of this year with the market looking at 2021 optimistically and saying, I'm going to expand the PE because this is the only game in town. And we may get up to new highs long before earnings capture or catch up, because you've got this really interesting dynamic between the health concerns and the market. Think about SARS 11 years ago. We have had a quantum 5x in terms of just research power of artificial intelligence, biotechnology, all of that stuff. We've got 102 companies developing therapeutics and a vaccine. If indeed we get good outcomes in Q4 of this year, I think you're in a cocktail of very high expanded multiples on equities, because interest rates will still be significantly lower than what they were when we came into this. And that is going to determine the flow of capital from sovereign and from pension. And you and I, as individual investors, are going to catch that wave. I'm extremely optimistic, and people keep telling me, why are you? And I'm trying to explain, follow the Fed, follow the funds, follow the sovereigns, follow the cash. Where's it going? Equities.
You think that means new highs, Kevin, within some intermediate time frame? Do you think we've got the power to do that with all this stimulus behind us?
You know, the answer, I don't want to be too optimistic, but I am. And the answer is yes. Will the new highs be hit this year? Don't know. There could be a rocky road in terms of, you know, the setbacks on research on therapeutics and the vaccine, if and when it comes. But it is not out of the, you know, possibility of reality to have new highs in Q4
we get a vaccine
as the
done
market
deal,
looks
new
into
highs?
next year.
Vaccine, new highs, is the equation simple?
Yeah.
Seems like right
Not
now
impossible.
there's a potential for a real big earnings bounce. And I like the way you bring this up, because I don't think this gets enough attention here, where the market's really expensive right now, but we have no idea what earnings are. It's basically guesswork with so many companies withdrawing guidance. That can cut both ways, right? It can leave us totally empty-handed if the guidance doesn't come back and the market's way too expensive, which would be the opposite end, kind of this like bubble risk. But if the earnings do come back, then suddenly we've got an equation that's very bullish. What's the chances of the former, Kevin, do you think? What's the chances that we're sitting here and we realize that market has been pumped up because there's nowhere else to put money and we're set up for another big sharp drop?
Yeah, I mean, look, there's always that possibility with really bad news on the virus front. I give you that, no question about it. But I'm far more optimistic than I was 11 years ago in terms of therapeutics or vaccine for SARS. I mean, it was extremely difficult, and we got through that. But there's something you got to remember. There is a new America coming out of this that may be significantly more productive. And I'll give you an example. I've got a portfolio of over 50 private companies. Not all of them are going to make it, because some are involved in food services or in entertainment or things that are going to take a much longer time to recover. But the typical company that has 80% are looking very good right now because they're involved in things that people are willing to buy online. But here's the thing I want you to think about. What we've realized operating remotely now, forced remotely, we didn't want to do this, we would have never taken this risk. No company would have said, everybody don't come to the office and work remotely. Our logistics, our compliance, our accounting, our marketing, all done remotely. But we have this remarkable technology. But here's what I'm fascinated about. So we had a call yesterday. I'm dealing with REITs in New York, Florida, Texas, and California. Our products are in thousands of outlets. We're not going to open the marginal retail outlet when this is over. No intention of doing that, because we found we're able to use tools like geo-locking Facebook ads and using online digital marketing to sell people that used to buy, let's say in our store in Tallahassee, we're selling them direct now. We're getting 80% of that business back because we know who the customers are and we have their data. So we don't need that real estate. Now we're asking ourselves, all these people working remotely, how about what number of you, let's say we have 100 employees, what percentage of you want to stay at home permanently? Is it 15%? Is it 20%? We're finding about 20% are saying, look, if you give me higher speed technology and you give me the equipment I need, I will vote to stay at home permanently, maybe come into the office 4 times a year, whatever, we don't care. I smell a 20% reduction in my requirement for expensive office space in pretty well every city I'm operating in. I think I can save 5 to 7% free cash flow across the portfolio. I'm not the only guy doing this. Everybody who's running a portfolio of investments like this is saying, wait a minute, we can get much more productive, much more efficient at the cost of the landlord. Okay, so real estate's going to have a hard time. Cry me a river. They've had a fantastic 30-year run. Now they're going to give some back. And the rest of America is going to get much more productive. The market senses that. You're going to start to see it in expanded margins and higher profitability. I can enhance profitability by 300 basis points across my portfolio after tax. Listen, it's not impossible to do this, and it's a new productive America, and that's why the market is looking forward at that opportunity.
All right, doesn't sound like you're ready to start short in any of the quarantine tech trades, Mr. O'Leary, by any means, but maybe on the commercial real estate side. Good to have you back here, Kevin. Appreciate you joining us again here on the TD Ameritrade Network.
Thank you.
Thanks. Kevin O'Leary, chairman of O-Shares ETFs.